welcome to the debate. So I want you to imagine for a moment that you have just designed a state-of-the-art skyscraper. You've brought in the absolute best structural engineers in the world, and they have designed this building to perfectly distribute its own weight. It can sway in a massive earthquake. It can withstand hurricane-force winds.
Right, it's a completely optimized structure.
Exactly. It is mathematically, fundamentally, an all-weather structure. But what happens to that perfect engineering when the ground underneath the building literally changes its physical properties? Does the math still hold up, or does the foundation just crumble?
Well, I think we both know the answer to that. The building goes down.
Yeah, and today that's exactly what we are examining. We're looking at the architecture of modern finance, specifically risk parity portfolios in a post-2022 landscape. Our discussion today is heavily rooted in the text risk parity beyond 60/40. And the core question we're unpacking is this: is risk parity still the monumental, all-weather intellectual leap in portfolio construction that we were promised? Or, did the violent correlation shifts of 2022 expose it as a dangerous leverage trap?
The latter. Unquestionably the latter.
Well, I come at this from the perspective that risk parity, despite its recent stress tests, remains the greatest portfolio innovation since Markowitz, purely because of its intelligent, mathematically sound approach to distributing risk.
And I look at the exact same data, the exact same historical stress test from 2022, and I see a deeply flawed premise. I'd argue that 2022 definitively proved the strategy is ultimately just a leverage trap. It relies entirely on fragile correlation regimes that inevitably break when the macroeconomic pressure gets too high.
Okay. To understand why risk parity was such a massive breakthrough, we really have to look at the problem it was trying to solve in the first place. And that problem is the standard 60/40 portfolio. 60% equities, 40% bonds.
The holy grail of investing for, 40 years?
Right. For decades, this was the golden rule. And it sounds balanced, doesn't it? 60/40. It feels like this engineered, perfectly calibrated scale. But when you inspect the structural mechanics of that conventional portfolio, you discover it's actually a complete illusion.
An illusion of balance, absolutely. Because, the dollar allocation doesn't match the risk allocation.
Yes, exactly. Equities are just vastly more volatile than bonds. So when you put 60% of your money in stocks and 40% in bonds, you aren't actually getting a 60/40 split of the risk. That 60% equity sleeve is actually driving something like 90% of the portfolio's total volatility.
Yeah, it's massive concentration risk masquerading as diversification.
Right? If the stock market crashes, your whole portfolio crashes. The bonds are just sitting there as this tiny little shock absorber that can't handle the weight of the cart. And this structural flaw was masterfully codified by Cliff Asness, Andrea Frazzini, and Lasse Pedersen in their seminal 2012 paper. This paper is foundational. It has hundreds of citations in the financial literature for a reason. They identified that this naive 60/40 split is driven by something called leverage aversion.
Which is a brilliant behavioral observation. I'll definitely give you that.
Yeah, the idea is that most investors, whether it's a retail investor or a giant, state pension fund, they either cannot or will not use leverage. They won't borrow money to invest. But they still have these really high return targets they have to hit. So what do? Because they can't lever up safe assets to get higher returns, they're forced to over-allocate to inherently risky high beta assets. They just pour all their money into equities.
Right, they chase the yield by taking on uncompensated equity risk.
Exactly. And Asness and his team proved that this behavior structurally misprices safe assets and overprices risky ones. Risk parity comes in and fixes this flaw. Instead of balancing the dollars, it balances the risk. You allocate capital so that your equities, your bonds, and your real assets all contribute equally to the portfolio's overall volatility. I view this as just a profound intellectual advance. Over the long horizon, this discipline of risk equalization yields superior Sharpe ratios.
Better risk-adjusted returns, yeah? On paper.
Not just on paper. When you look at the 2 centuries of defensive strategy success documented by Baltussen and his colleagues in their 2026 paper, it validates this framework completely. It is the purest application of modern portfolio theory we have.
Okay, look, I understand the appeal. The mathematical elegance of balancing risk contributions on a spreadsheet is incredibly seductive. You look at the math and it seems flawless. But a spreadsheet does not negate the physical reality of how that balance is actually achieved in the open market. The core assumption of risk parity, the absolute load-bearing pillar of the entire strategy, is the existence of stable, negative correlations between stocks and bonds. It assumes that when equities decline, bonds will automatically rally to offset the damage.
Which, historically, they have done.
Until they don't. That assumption is fundamentally flawed during acute macro shocks, because to achieve that equal risk contribution you're talking about, without sacrificing the total return the investor needs, the strategy demands leverage. You have to borrow money to lever up the low volatility asset, which is typically sovereign bonds. And that, my friend, brings us to 2022.
Ah, yes. The great stress test.
We have to look at 2022 not just as a bad year, but as the ultimate structural stress test of this theory. In that year, correlations flipped. Stocks and bonds fell simultaneously under the crushing weight of structural inflation and rapid central bank tightening. And because the risk parity framework necessitated borrowing money to lever up that bond sleeve, the leverage mathematically amplified the destruction. My core thesis today is that risk parity assumes stable correlation regimes that simply do not exist when you actually need them, like in 2008, the liquidity crisis of March 2020, and obviously the long grind of 2022. It renders the strategy structurally fragile right when investors rely on it most.
Okay, let's get into the mechanics of this, because I think to really debate the failures of 2022, we have to deeply understand the underlying physics of how these portfolios are built. I want to go back to that Asness, Frazzini, and Pedersen 2012 framework for a second, because it diagnoses a uniquely human constraint. Think about a pension fund manager. Let's call her Sarah.
Okay, Sarah, the pension manager?
Right. Sarah needs to generate, say, a 7% annualized return to meet the liabilities she owes to retirees.
Yeah, she has a hard target. If she misses it, the fund is underfunded and she's in trouble.
Exactly. Now, in a perfectly rational, unconstrained world, Sarah would buy a perfectly diversified portfolio of all the world's assets: stocks, bonds, real estate, commodities. This is the theoretical market portfolio. It's incredibly safe, incredibly diversified, but maybe it only yields a 4% return. In pure finance theory, the solution is simple. Sarah should take that incredibly safe 4% portfolio, borrow some money at a low rate, and scale the whole thing up until it hits her 7% target.
Right, levering the whole pie equally.
Yes, it's mathematically safer to lever a highly diversified portfolio than it is to concentrate all your money in risky assets. But Sarah is constrained. Her board of directors says, no leverage, it's too dangerous, we don't do that here. So what does she do? She abandons diversification. She takes all the money and concentrates it in equities, because equities are the only asset class with a high enough expected return to hit that 7% target. She becomes a captive to equity market drawdowns.
And Asness argues this pushes the price of equities up and depresses the price of safe bonds, creating the leverage aversion premium.
Yes, exactly. Risk parity essentially says, we are going to do the mathematically correct thing. It uses leverage on the low volatility assets, primarily fixed income, to elevate their risk contribution so it matches the equities. You are mathematically diversifying the drivers of return. You aren't just betting on corporate earnings anymore. You are equally exposed to interest rate yields, inflation premiums, and economic growth metrics. It is Harry Markowitz's Nobel Prize-winning concept of diversification, finally unconstrained by this artificial fear of leverage.
Okay, I'm not going to argue with the academic theory of the leverage aversion premium, the idea that constrained investors overpay for high beta equities and underpriced safe bonds. That's sound. But here's where we have to transition from the theoretical realm of Asness's chalkboard to the mechanical, operational reality of financial leverage in the real world. You keep using the word pure. You call it the purest application of diversification.
But if the mechanism of your pure diversification requires borrowing massive amounts of money to lever up an asset whose fundamental driver is shifting, aren't you just replacing equity concentration risk with interest rate concentration risk?
I'm not sure I agree it's concentration risk because the sizing is mathematically inverse to the volatility.
But let's unpack how that sizing actually works mechanically. Let's look at applying multipliers to bond sleeves. In a typical risk parity implementation, the manager might allocate 20% of the actual capital to equities. To balance the risk, they might apply a 3-to-1 or even 4-to-1 multiplier to the bond allocation.
Wait, let me stop you there for the listener. Break down exactly what you mean by a 3-to-1 multiplier in this context. How does a fund actually do that? They don't just walk into a local bank and take out a mortgage on a treasury bond.
Good point. No, they use derivatives, usually treasury futures or repurchase agreements, repos. Basically, they use a very small amount of cash to control a massive amount of bonds. They are synthetically expanding their balance sheet. So on paper, the portfolio looks perfectly balanced because the historical volatility of the stocks matches the levered historical volatility of the bonds. But operationally, you are now carrying a massive, highly sensitive, levered exposure to interest rates. When you expand a balance sheet using borrowed money, you introduce a non-linear sensitivity to the cost of that borrowing. The overnight rate, the Fed funds rate.
Right, you're talking about the cost of the leverage itself.
Exactly. So what happens if central banks suddenly raise the short-term rates you are using to fund your leverage, while simultaneously that exact same policy crushes the value of the long-term bonds you actually own? The mathematics of your equalized volatility completely collapse. You aren't diversified at all. You have a singular catastrophic exposure to monetary policy.
Okay, I see your point. That analysis assumes monetary policy operates in a vacuum. It assumes the Fed is just raising rates for fun, completely detached from the economic growth metrics that govern the equity side of the portfolio. The whole point of risk parity is that the leverage applied to the bond sleeve is systematically calibrated against the real-time volatility of those bonds. And historically, the interest rate exposure you're warning about is exactly what provides the deflationary protection that equities entirely lack. If we hit a recession, equities crash, central banks cut rates, and those levered bonds explode in value, saving the portfolio.
But that assumes a disinflationary recession. That assumes 2008.
Which brings us to the exact historical moment where your theory of fragility manifested, the 2022 postmortem. I want to talk about 2022. I acknowledge the events of that year. I am not going to sit here and dismiss the severity of the drawdown. But we must contextualize 2022 as a severe, singular regime shock, not a permanent invalidation of a mathematical law.
A singular shock that destroyed billions of dollars of wealth.
Let me use an analogy here, going back to our structural engineering concept. Consider a skyscraper that is specifically engineered to sway during a massive earthquake. The building is designed to dissipate seismic energy by moving with it. Now, suppose an unprecedented once-in-a-century earthquake strikes, a 9.5 magnitude quake with a totally unique vector. The building sways, but the force is so extreme that the building sustains structural damage. Windows shatter, maybe a support beam cracks. If you look at that damage, do you conclude that the architectural principles of structural elasticity are fundamentally wrong? Do you say, well, swaying doesn't work, we should just build rigid buildings again? No. You say the stress test was unprecedented in its magnitude.
I have a serious problem with that skyscraper analogy.
Why? It perfectly describes a system handling an extreme outlier event.
Because if a building is designed to sway during an earthquake, but the building's core structural integrity relies on an assumption that the wind will always blow in the opposite direction of the seismic wave, then the engineering isn't just stressed, it's fundamentally defective. In your analogy, the engineers assumed two destructive forces would always cancel each other out. Let's actually look at what happened in 2022, explicitly drawing from the narrative in the text. We had a massive inflation shock, primarily driven by pandemic supply chain issues and unprecedented fiscal stimulus. To fight it, Jay Powell and the Fed hiked rates at a pace we hadn't seen in decades.
Right.
It was the steepest trajectory of rate hikes in modern history.
Exactly. So what did that do to our benchmark? In 2022, a standard unlevered 60-40 portfolio lost roughly 17% of its value. That happened because stocks and bonds fell together under the weight of those rising interest rates. A 17% loss is incredibly painful, but it is unlevered, linear pain. You just take the hit on the chin. Now let's look at the all-weather machine. A diversified risk parity fund utilizing 2 times leverage on its bond sleeve suffered a brutal 25% drawdown that same year.
Because of the simultaneous repricing.
Yes, but let's break down how that repricing destroyed the fund. It wasn't just a dual decline, it was a triple threat. First, rising rates crushed the bond valuations. Second, the slowing economy and rising discount rates crushed the equity valuations. And third, and this is the killer, the rapidly increasing cost of capital crushed the leveraged funding mechanism. The cost to roll those repo agreements skyrocketed. All 3 pillars of the strategy deteriorated simultaneously. The sway of your skyscraper didn't save it, the sway tore it apart.
I hear that, but you're looking at a specific implementation failure in a specific calendar year. We have to look at the longer horizon. The Anderson, Bianchi, and Goldberg study from 2012 clearly demonstrates risk parity's massive outperformance over much longer periods. And let's not forget Bridgewater. Ray Dalio and Bridgewater pioneered the all-weather concept. They proved that this core philosophy can work over decades. They've navigated multiple economic cycles by equalizing risk vectors.
But using Bridgewater to defend retail or standard institutional risk parity is incredibly misleading. Bridgewater's internal models are intensely dynamic, they're proprietary, they involve thousands of sub-indicators, macroeconomic tracking, real-time regime sensing. The risk parity products sold to the broader public, the ones that got decimated in 2022, they're largely mechanical.
What do you mean by mechanical specifically?
I mean, they apply static multipliers based on trailing covariance matrices.
Okay, before we go further, let's unpack trailing covariance matrices for a second, because I want to make sure we're not losing anyone in the math.
Fair enough. Think of a covariance matrix as a historical spreadsheet that tracks how different assets move in relation to each other. It looks in the rearview mirror, it says, okay, over the last 3 years, when stocks went down 1%, bonds went up 0.5%. A mechanical risk parity fund uses that historical spreadsheet to set its leverage for tomorrow.
It assumes the near future will behave like the recent past.
Exactly. So when the macroeconomic regime shifted abruptly in 2022 from a low-inflation, disinflationary environment to a high-inflationary environment, those historical covariance matrices were feeding the model's bad data. The models looked at the spreadsheet and said, bonds will protect us from this equity drop, so keep the leverage high. Instead, the bonds acted as a massive accelerant to the downside. The spreadsheet lied because the regime changed.
Okay, but the mechanical application of a trailing indicator by an inferior fund manager doesn't indict the underlying premise of risk equalization. Your citation of a 25% drawdown for a heavily levered fund highlights an implementation failure. They failed to adequately stress test for a simultaneous asset class repricing. But let's broaden the lens here. If we restrict our entire judgment of portfolio theory to the calendar year of 2022, we are succumbing to profound recency bias.
It's not recency bias if the structural mechanics of the market have permanently shifted.
But have they?
Let's look at the Baltussen, Van Vliet, and Vanderwaal's research published in the Financial Analyst Journal in 2026. This is incredibly comprehensive research. They examined 2 centuries of defensive strategies, 200 years of market history.
Yes, going back to the 1800s.
Right. And think about what is contained in that data set. It encompasses the American Civil War, 2 world wars, the complete abandonment of the gold standard, the Great Depression, the stagflation of the 1970s, and varying structural inflation spikes. Across that immense, chaotic expanse of human history, the strategy of defensively distributing risk and intelligently applying leverage demonstrated persistent, robust success. It worked. So, dismissing a 2-century empirical track record because of a single acute inflationary shock, orchestrated by a once-in-a-century pandemic, broken supply chains, and unprecedented fiscal stimulus, orchestrated by those specific events. It's analytically unsound.
The data provides incredible empirical comfort that defensive risk balancing remains structurally superior to concentrated equity risk over any meaningful time horizon.
I completely question the utility of analyzing 2 centuries of historical data when the fundamental mechanics of the financial system have transformed so radically. You're talking about 19th century data on bond yields and equity returns. That does not reflect a world governed by quantitative easing, zero interest rate policies, and hyper-interconnected global central banking. The structure of money itself has changed.
Human behavior hasn't changed. Leverage aversion hasn't changed.
But the sovereign bond market has. In the 1800s, the central bank wasn't buying trillions of dollars of its own debt to suppress yields. Relying on 200 years of historical correlations to justify leveraging a modern bond portfolio provides entirely false comfort. The source text actually introduces some vivid analogies that capture the reality of this regime dependence, and I think they are much better than your skyscraper.
Let's hear them.
The text says risk parity is exactly like all-weather clothing that fails in a hurricane, or a bridge designed for normal traffic that collapses the moment an extraordinary load is placed on it. My favorite is that it's like an insurance policy that systematically collects your premiums during peacetime, but the second the disaster hits, it invokes some technicality and doesn't pay out.
That's a bit hyperbolic. The bonds still paid their yields. The prices just dropped.
But the portfolio didn't pay out its protection. And that brings up the supreme danger articulated in the text, which they call the wild card. The real risk here isn't simply that a risk parity strategy underperforms a 60-40 by a few hundred basis points. The profound danger is that it fails at the exact moment investors believed they were comprehensively protected. Think about 2008. In 2008, everything melted down, but bonds rallied hard and saved the 60-40 portfolio. For risk parity, with its levered bond sleeve, it was a massive victory. It functioned as an impenetrable shield.
It did exactly what it was supposed to do.
Yes, but it gave investors false confidence. It taught an entire generation of allocators that the leveraged bond sleeve would always function as a shield. Fast forward to 2022, and that exact same shield became a heavily weighted anchor pulling the whole ship under.
I think saying modern central banking renders all historical data irrelevant is an overstatement. The fundamental pricing of risk premiums transcends specific monetary regimes. But I will acknowledge the validity of your critique regarding regime fragility. The static, unyielding application of risk parity, the set it and forget it approach, based purely on trailing correlations, was severely compromised by the correlation flip. I concede that. But this brings us to the necessary evolution of the model. The diagnosis of the problem leads directly to the proposed solution, which is adaptive risk parity.
Oh, here we go, the algorithmic savior.
It is the future of portfolio construction. The FAJ 2025 proposal details the use of hidden Markov models for precise regime detection.
Which is incredibly dangerous.
Let me explain it first. A hidden Markov model, or HMM, is an advanced statistical framework. It probabilistically determines the hidden state of a system based on observable outputs. Think of it like trying to figure out if someone is using a loaded die in a casino. You can't inspect the die directly. The state is hidden. But by algorithmically monitoring the sequence of the rolls, the observable outputs, the math can eventually determine with high probability that the die has been switched from fair to loaded.
Right.
In finance, the hidden state is the macroeconomic regime. Are we in an inflationary correlation regime or a deflationary one? By applying an HMM to monitor rolling stock bond correlations, a portfolio can systematically detect when the economic environment shifts. When the model detects that the correlation regime is flipping from negative to positive, meaning stocks and bonds are beginning to fall together, the system automatically and dynamically reduces the leverage applied to the bond sleeve. It transitions the portfolio out of its static vulnerability and actively mitigates the drawdown risk before the simultaneous decline accelerates.
I'm sorry, but introducing hidden Markov models to save the risk parity framework introduces an entirely new set of devastating vulnerabilities. You're pivoting from structural mechanics to algorithmic market timing, which is notoriously perilous. We really have to critique this reliance on regime-based allocation.
How is it more perilous than sitting in a static portfolio while the macro environment burns around you?
Because you're trading one type of fragility for another. Let's unpack the severe risks associated with a hidden Markov model operating in a financial time series. You face immense risks of model overfitting, where you perfectly tune the algorithm to survive past crises, but it fails the next one. You face delayed and lag detection, and you face repeated false signals that cause portfolio churn.
The models are calibrated to avoid noise.
But the fundamental mathematics of these models rely on looking backward to determine the present state. My question to you is this. By the time a hidden Markov model confirms that a statistical regime shift has definitively occurred, hasn't the catastrophic drawdown already happened? You are effectively designing an airbag that deploys 5 seconds after the crash.
That's a fundamental misunderstanding of the speed of these models.
Is it? Think about the violent velocity of the fixed income repricing in early 2022. A rolling correlation metric, by its very mathematical definition, requires a window of time to pass before the statistical significance of the shift triggers an action. You need enough die rolls to prove the die is loaded. During that lag, your leveraged bond sleeve is absorbing massive daily losses. Now, if you attempt to shorten the look-back window to make the model more responsive, say looking at a 10-day window instead of a 60-day window, you generate constant false positives. The model will think every minor market hiccup is a regime shift. It will force the portfolio to buy and sell leverage repeatedly, destroying your returns through transaction costs and whipsawing. You cannot solve a structural market problem with an over-engineered statistical lag.
Calling it an airbag deploying 5 seconds late makes for a great soundbite, but it dramatically underestimates the sophisticated predictive momentum and trend-following signals integrated into modern quantitative models. A properly calibrated hidden Markov model doesn't wait for a 30% drawdown to classify a regime shift. It identifies the shifting distribution of daily volatility and short-term correlation matrices very early in the cycle. It sees the distribution tail fattening before the bulk of the move happens. Furthermore, this transition to adaptive models is just one element of the framework's evolution. We also need to examine the practical structural implications outlined in the text for how these portfolios are actually built going forward.
You mean the guardrails?
Yes, the text establishes concrete, actionable rules that fundamentally fix the issues of 2022. First, capping leverage at exactly 1.5 times.
A hard cap?
A hard cap. This specific threshold is critical. It provides enough multiplier effect to elevate the risk contribution of fixed income and generate a solid return profile. But it explicitly prevents the type of ruinous existential drawdown experienced by the 2x or 3x levered funds in 2022. By enforcing a hard ceiling on gross exposure, the portfolio survives the exact tail risk event you described. You don't get a margin call that spirals out of control. Second, and this is vital, true risk parity must expand beyond nominal bonds. The text mandates the inclusion of real assets, broad commodities, and TIPS, Treasury inflation-protected securities.
Which makes perfect sense, considering nominal bonds were the exact instruments that failed.
Right. The failure in 2022 was partially a failure of asset selection. Nominal bonds offer zero protection against structural inflation. A properly constructed risk parity portfolio utilizes a robust inflation protection module. So when nominal assets fall because Powell is hiking rates, the commodity and TIPS sleeves mathematically expand to absorb the volatility. They catch the falling knife.
Okay, let's address these fixes, because I think they actually prove my point. Let's start with capping the leverage at 1.5x. This presents a severe mathematical contradiction to your original thesis. Think back to the beginning of our conversation. The original proposition of risk parity, the whole reason Asness and Dalio justified departing from the standard 60-40, was that risk parity could match or exceed equity-like returns with significantly lower volatility.
Correct.
But if you structurally cap the leverage at 1.5x to prevent ruin, you mathematically compress the expected return of the strategy. I have to admit, I'm hung up on the math here. If we cap the leverage, aren't we just neutering the exact returns we built this machine to generate? You arrive at a portfolio that survives a 2022-style event, sure, but it will massively underperform a basic equity index over every subsequent decade because it lacks the necessary thrust.
It gives up a fraction of upside to eliminate the left tail risk of ruin. That is a highly rational trade-off for an institutional allocator.
But it's a retreat. And regarding the inclusion of real assets and commodities, yes, that is entirely logical. But it further demonstrates the retreat of the core risk parity doctrine. The text suggests treating risk parity as just one module in a larger allocation, rather than an all-encompassing portfolio solution. Let's be honest about what this means. Modularizing risk parity is a tacit admission of failure. It is an acknowledgement that the strategy fundamentally failed its original promise of being a standalone all-weather solution. If your strategy requires a hard leverage cap that neuters its returns, if it demands complex statistical models that lag the market, and if it must be hidden within a broader multi-asset portfolio just to conceal its vulnerabilities, then the philosophical premise of risk equalization as a universal solution has collapsed.
It is not collapsed. It is a maturation of the science. When quantum mechanics refined the limits of Newtonian physics, we didn't say physics collapsed, we said it evolved. Modularizing the strategy does not invalidate the underlying mathematics of risk equalization. Treating risk parity as a specific, highly efficient component of a broader multi-asset diversification strategy honors its strengths while pragmatically addressing its boundaries.
But you're changing the definition of the strategy.
No, the inclusion of commodities and tips isn't a retreat, it is the fulfillment of true parity. Think about it. Nominal bonds and equities represent claims on future cash flows. That makes them inherently vulnerable to unexpected inflation. Commodities, on the other hand, represent physical reality. A barrel of oil is a barrel of oil. By equally balancing risk across economic growth, disinflation, and inflation, the portfolio becomes structurally robust. The practical mandate to stress test for 2022 style simultaneous drawdowns ensures that these leverage constraints are grounded in worst-case historical realities, not just theoretical covariance matrices. Risk parity remains a highly valuable framework for balancing portfolio risk, provided it is adapted with profound regime awareness, strict leverage limits, and comprehensive real asset diversification.
I hear you. But the evolution you are describing fundamentally alters the identity of the strategy. It transforms what was once a precise, elegant, rules-based mathematical solution into a highly discretionary, highly complex, active management strategy. It's now burdened with the very forecasting risks and regime timing bets it initially sought to eliminate. My position remains that this framework must be viewed with intense skepticism by any allocator. The inherent reliance on leverage, even capped at 1.5x, will always exact a severe toll when correlations inevitably break. And they will break again.
But you can't abandon diversification just because correlations temporarily converge.
I'm not abandoning diversification. I'm saying the market is not a closed thermodynamic system where equations hold true perfectly. It is a complex, reflexive environment driven by human panic, liquidity constraints, and central bank interventions. When liquidity evaporates from the system, all assets become perfectly correlated on the downside. We have to recognize that all weather does not mean all crisis. The assumption that historical data, even spanning 2 centuries of Baltussen's research, guarantees future protection against novel monetary phenomena is a dangerous foundation for capital allocation.
So, if we take all of this, the evolution, the modularization, the 1.5x cap, the HMM regime detection, it feels like we're acknowledging the math is essentially right, but the real-world application requires incredibly strict guardrails.
Exactly. The fundamental issue isn't the equation itself. Risk parity is not wrong in theory. It is fragile in exactly the regimes where investors need it most.
Which leaves us with a framework that requires constant evolution. The science of portfolio construction is never truly settled. The historical data, the regime models, and the mechanics of leverage offer so much more to explore. Our understanding of structural equilibrium in finance will continue to adapt. We'll leave it there for today. Thank you for listening.